For a long time, investing felt simple. You bought good companies, stayed patient, and trusted that markets would move higher over time. In the United States especially, this strategy worked for decades. Low interest rates, easy money, and strong economic growth rewarded investors who followed traditional rules. But today, Tier 1 markets like the US, Canada, and the UK are clearly signaling that those rules are changing, and investors who rely only on old strategies may struggle in the years ahead. The global investment landscape has entered a new phase. Inflation is no longer just a short-term concern. Interest rates are higher, capital is more expensive, and economic cycles are less predictable. In the U.S., decisions made by the Federal Reserve now have a much stronger and faster impact on stocks, bonds, housing, and even crypto markets. This environment is forcing investors to rethink how they allocate money and how they manage risk. One of the most important new rules of investing is that macroeconomic conditions can no longer be ignored. In the past, many investors focused only on company earnings and growth potential. Today, factors like inflation trends, bond yields, and monetary policy directly influence stock valuations. When interest rates rise, future profits become less valuable in today's dollars. That is why Tier 1 markets are favoring companies with strong cash flow, stable revenue, and real pricing power, instead of purely speculative growth stories. Another major shift is how diversification works. Simply owning many stocks is no longer enough. In recent years, U.S. markets have shown that during periods of stress, many stocks move in the same direction. True diversification now means spreading risk across different asset classes. Investors are paying more attention to bonds, dividend stocks, commodities, and even defensive sectors that perform well during economic slowdowns. The goal is not to avoid risk entirely, but to build portfolios that can survive different market environments. Income investing has also made a strong comeback in Tier 1 markets. For years, low interest rates made income strategies unattractive. Today, U.S. Treasury yields, high-quality bonds, and dividend-paying stocks are once again meaningful sources of return. Investors are realizing that steady income can provide stability, reduce stress during market volatility, and help compound wealth over time, especially when markets move sideways.
Volatility itself has become a permanent feature of modern investing. Sharp rallies, sudden corrections, and rapid sentiment shifts are now common in U.S. markets. This has made emotional investing extremely dangerous. Successful investors are moving away from reacting to headlines and social media trends. Instead, they are focusing on disciplined strategies, long-term planning, and clear decision-making rules that remove emotion from the process. Technology continues to reshape markets, but Tier 1 investors are becoming far more selective. Artificial intelligence, automation, and digital transformation are powerful forces, yet not every company benefiting from these trends will succeed. U.S. markets are sending a clear signal that profitability, scalability, and competitive advantage matter more than investors are rewarding businesses that can turn innovation into sustainable earnings. Liquidity is another critical lesson coming from Tier 1 markets. Holding cash is no longer seen as being out of the market. Instead, it is viewed as a strategic tool. Cash provides flexibility. It allows investors to act quickly during market pullbacks, take advantage of discounted assets, and reduce overall portfolio risk. In uncertain times, liquidity equals opportunity. Risk management has become a priority rather than an afterthought. In the U.S., professional investors are focusing more on protecting capital than chasing aggressive returns. Position sizing, portfolio rebalancing, and risk limits are being used more actively. The mindset has shifted from maximizing gains to ensuring long-term survival and consistency. Another important rule emerging from Tier 1 markets is the value of patience. Fast money strategies and short-term speculation may look attractive, but they rarely build lasting wealth. Investors who succeed over time are those who remain disciplined, avoid overtrading, and stay aligned with long-term economic trends rather than short-term noise. Perhaps the biggest message from Tier 1 markets is that investing is no longer passive. It requires awareness, education, and adaptability. Economic conditions change, policies shift, and markets evolve. Investors who continuously learn, adjust their strategies, and stay informed are far better positioned than those who rely on outdated assumptions. So what are Tier 1 markets really telling us? They are telling us that the future belongs to prepared investors, those who understand risk, respect market cycles, and focus on quality over speculation. Blind optimism is no longer enough. and fear is equally dangerous. The winning approach lies in balance, discipline, and strategic thinking. As the U.S. and other Tier 1 markets move forward, the most successful investors will not be the loudest or the fastest, but the most consistent. They will build resilient portfolios, manage risk intelligently, and remain flexible in a rapidly changing world. These are the new rules of investing, and ignoring them is no longer an option.